Good day, students. Once again, I will be doing chapter 16 of the prescribed textbook. And this chapter is on the topic called standard costing. Therefore, now we will be dealing or doing variances on the topic of standard costing. And there are some variances that I want to bring to your attention, which we will normally be required to do them in the textbook. The first variance is the direct material variance, and there are two variants under direct material, which is direct material price variance and direct material usage variance. And it says SP minus AP times by actual quantity purchased, which is AQ. Then we have SQ minus AQ used times by SP. So now we first have to understand where are these abbreviations coming from. Hence, it becomes very important that you master these formulas. SP means is the standard price per kg. That means the price at which the kgs of material are bought, or the price at which the liters or meters or grams of material are bought. Then the SQ is what is called standard quantity, and standard quantity is calculated by saying actual production times by the standard material per unit. So now that means we need to know the actual production, meaning the units that are completed, and we multiply that by the standard material per unit. Remember, standard material per unit is the kgs of material that are required to complete one unit. These are the kgs of material that are required to complete one unit. Kgs of material required to complete one unit, or needed to complete one unit. So now that will be the standard material kgs per unit. It could be meters, liters, or kgs. It will depend to the product that you are dealing with. But these are the standard kgs, meters, or liters that are required or that are needed to complete one unit. Then AP is the actual price paid per kg. That means the price now that we pay to buy material from the supplier. Remember, the SP was the standard price, the price which is, I might call that budgeted price. Then when we go to buy material from the supplier, we might get a different actual price, which will also be per kg or per meter or per liter or per gram. Then now we have AQ, which is actual quantity purchased. Therefore, now AQ is the actual quantity purchased. That means the material that we actually buy. Therefore, now that will be represented by AQ purchased. Then AQ used will be the actual quantity used. That means the kgs of material that were issued to production, because the only time we make use of the material is when the material is issued to production. Therefore, now that will be the actual quantities of material that have been issued into production. Therefore, now as I said to you that these are the two variants that we'll be focusing on, and this is just the terminology that we have to understand in the completion of this variance. Then after, we have other two variants when it comes to the direct labor. There are two variants, which is the direct labor rate and the direct labor efficiency variance, where we look at the efficiency of the employees in achieving higher quality in the production process. Therefore, now we also have some abbreviation or some concept that we need to understand before we proceed with this variance. We need to know the standard rate, and the standard rate is the standard rate set per hour or per labor hour. This is what employees are paid per hour, who are normally called direct employees. So now this is the rate per hour. That means the rate that employees get to be paid per hour. Then we also need to know the alphabet called SH, which is the standard labor hours. Therefore, now these are the standard labor hours which we will be calculating, and they'll be based on also the actual production times that by the labor hours per unit. So now that means when we are calculating the standard hours, then we need to know the actual or the completed units, and we multiply that by the labor hours per unit. Remember, labor hours per unit is the number of hours that are required or that are needed in order to complete 1 unit of a product. Now, if you see with these two variants that we have done so far, there is some comparison that I want to bring to your attention. We had SQ, which was standard quantity, and now we have SH under labor, which is standard hours. And there is commonality between the two, because in the calculation of standard quantity, we take actual production and we multiply that by the material needed to complete 1 unit. And once again, under the standard hours, we take the same actual units that are completed or actual production, but we multiply this by the number of labor hours that are required to complete 1 unit. So now also take into account this simple way on how you can master the variance. Then now we have AR, which is the actual labor rate paid per hour. Therefore, now this will be the actual rate that the company paid to the employees in the production of the units that were budgeted. Remember, the SR, which is the standard rate, will be mostly the budgeted rate, which is the rate that will be budgeted to be paid to each employee when they produce the units that are under budget. Therefore, now the actual rate will be the rate that employees get to be paid by doing the actual job. Remember, there can be increase in the labor rate, maybe sometimes due to unions that are negotiating a labor rate. Sometimes it can be due to the employees that can strike for their own labor rate to increase. So now if there is an increase in the labor rate, therefore now that might mean that the standard rate can be different from the actual rate that employees get to be paid, and that will lead to what we call the labor rate variance. Then after we have the AH, which is the actual hours worked by laborers. So now that AH will be the actual hours that are worked by employees. Then now we have there's two variants, which is the direct labor variance. It says SR minus AR times by AH, which is standard rate minus actual rate times by actual hours. And this will be standard hours, which is the direct labor efficient standard hours minus actual hours. Please don't forget that standard hours get to be calculated. Standard hours, we have to calculate standard hours, where we have to get the completed production, and we multiply the completed production by the number of labor hours it takes to complete 1 unit, which we call that standard labor hours per unit. Therefore, now we go again to the next part, and the next part will be the next variance, which is the variable overhead variance. And that variable overhead variance, we need to bring into our attention again some concepts, and the concepts that are here, some of them, they were already taken into account when we did the direct labor variance. And this there are also two variants here, which is the first variance is the rate variance, and the second variance is the efficiency variance, which is 1 and 2 variants only. This information is information that we need to understand in order for us to do our variance. So now, hence I bring your attention to those information, which is very, very crucial. So now we have the two variants, which is 1 and 2. And we also need to understand the terms SR, which is the standard variable overhead rate set per labor hour, which is the rate of overhead per labor hour. Then we also need to know the SH, which is the standard labor hours. Remember, standard labor hours, we also had the standard labor hours when we're calculating the labor variance. It's the same standard hours that we calculated, where we need to take into account the actual production and we multiply that by the labor hours per unit, which is the number of hours it takes to complete 1 unit of a product. That will be the standard labor hours per unit. Then now we have AR, which is the actual rate of overhead. Therefore, now this will be the actual rate that gets to be paid per labor hour in terms of overheads. Then after, we bring your attention to AH, which is the actual labor hours that are worked. And actual labor hours is that's just the actual labor hours that will also be the same actual labor hours that you would have utilized when you calculated the direct labor variances. So now we continue on that same note to the last part of our variance, which is the fixed overhead variances. And our fixed overhead variances, and to make mention of the fact that overheads are allocated according to labor hours. Please take that into your attention. And also with the overhead variance, variable overhead, they told us that overheads are allocated according to the direct labor hours. So now that means the base to allocate our overheads will be the direct labor hours. Then now we proceed to the last variance, which is the fixed overhead variances. And we need to understand that we will need to know the budgeted fixed overhead, which is equal to budgeted production times by the standard fixed overhead per unit. That means if we are given our overhead per unit, which is POR in this case, fixed overhead per unit will be POR when the POR is based on the number of units produced. And I will leave that there. I will not explain that in details because there's a full chapter that covers that part. So now, obviously, the fixed overhead per unit will be when your POR was based on the number of units manufactured. Therefore, now you multiply that by the budgeted production, and that will give you the budgeted fixed overhead cost. Then we also need to know the actual fixed overhead, and actual fixed overhead for the period will normally be given because we have no calculations of actual fixed overhead. It's just the cost that will be actually incurred. Therefore, now we just take our actual fixed overheads as they are. Standard hours is the same standard hours that we calculated previously. Nothing has changed. So now the standard hours, as I said to you, that it is actual production times by the number of labor hours it takes to complete one unit, which is the standard labor hours per unit. And BH, which is budgeted labor hours, is calculated by saying budgeted production times that by the labor hours per unit, times that by the standard labor hours per unit. Remember, standard labor hours per unit is the number of labor hours it takes to complete one unit of a product. The number of hours that employees take to complete one unit of a product. That is the standard labor hours per unit, which is represented by SR, standard, that is the standard hours. Then after now we go to the next one, which is SR. SR is the standard fixed overhead rate per labor hour. Take note of the fact that here it is per labor hour. Why per labor hour? Because overheads are allocated using direct labor hours as the base. Therefore now, after we have done the allocation using the base of labor hours, then that will give us the standard rate per labor hour. Then after we have budgeted fixed overhead divided by budgeted labor hours. That is how we get to the standard fixed overhead rate per labor hour. We get the total of our budgeted fixed overhead, and you divide that by the budgeted labor hours. And after you have done that, you'll get to the standard rate, which is the predetermined overhead rate, in other words, which is POR. And that POR, it will definitely be per labor hour because the base is also labor hours. Then now we proceed to the last part, which is the actual hours. Actual hours is the actual hours that are worked by the direct employees. That will normally be given, or you have to just use the information provided to you to calculate that. Then now the last variance that we have is the variance number 1, variance number 2, and this will be 1.1, this will be, okay, this will be 2.1 and 2.2, if I may say that. 2.1 and this will be 2.2 because these two variants, they are made of their second variance. Therefore now under fixed overhead, under fixed overhead expenditure or spending variance, we need to know that it is budgeted fixed overhead minus actual fixed overhead. That will be fixed overhead variance, the difference between fixed overhead costs that were budgeted and the actual fixed overhead that actually took place. Therefore now that will be fixed overhead variance. Then after we have fixed overhead volume variance, therefore now that will be standard hours minus budgeted hours times that by the standard rate. And remember that the standard rate is the standard rate per labor hour, not standard rate per unit. This is the standard rate. Standard rate is per labor hour because our fixed overhead are based on labor hours. Then after we will have other two variants, and these two variants are the sub variance for this previous variance. That means the net of these two variants will give you the previous variance. Therefore now they sometimes require you to do such. Therefore now that will be fixed overhead volume efficiency variance, where we calculate the efficiency with regard to our fixed overhead cost. Then that will be standard hours minus actual hours times by standard rate. Then now that will be a variance, fixed overhead volume efficiency variance. And the last one will be fixed overhead volume capacity variance, which will be actual hours minus budgeted hours times that by the standard rate of fixed overhead per labor hour. And I'm emphasizing that it is per labor hour, not per unit. Therefore now from here we can do the exercise. That was just a bit of introduction. And now from here we can do the exercise in the prescribed textbook, and the exercise that I will be doing in the prescribed textbook will be question 16.5, a very important question that brings our attention to the variance that I have just highlighted above. So now I will be doing sometimes a cross-reference just to remind you that where are the formulas coming from and how do we do other calculations and why do we do other calculations. More especially with regard to the standard quantity of material and the standard labor hours, because standard quantity of material and standard labor hours get to be calculated by taking into account the actual production. Then now we have 16.5 that I will be doing. It says in 16.5 that Selena Close Corporation manufactures a single product and make use of their standard costing system. And the budgeted figures for April 2005 were as follows. So now we do have the budgeted information that is given to us as follows. So now the standard information is given in terms of the direct material per unit. Remember, although they say per unit, this is per unit, they tell us that. So now that means we need 10 kgs per unit. So now that 10 kg will be standard material kgs per unit. Remember, the standard material kgs per unit was from the material variance, where we said SQ, standard, okay, that was standard quantity. Okay, this was standard price of material. Oh yes, then we do have our standard quantity. This is the standard material per unit. So now that 10 kgs will be here. That will be the 10 kg that we're talking about. That will be multiplying about. So now that will be the standard kgs of material per unit. As I said to you, that is standard kgs, which will be used when we calculate the material variance. So now that will be the standard kgs. Let me just write that. Standard kgs per unit. That means this is the number of kgs that are needed to complete 1 unit. Then they say at 25 cents. Therefore now this will be the standard price of material per unit, meaning the material that we need. And the standard price will be the standard price, which is called SP. This will be the standard price, which is called SP. So now that SP is the one that we have seen in the material variance, which is the standard price. That standard price, which is the standard price SP, and we see that standard price in the variance for the material price as SP. So now that will be the price that will be substituting when we are doing our variance in terms of material. Then after now we have the direct labor per unit. Therefore now they give us 8 hours. This is the standard labor hours per unit, meaning the number of hours it takes to complete 1 unit of a product, and that is called standard labor hours per unit. Then now we have the at 1 rand 40 per hour. That means our employees are paid 140 cents per hour. That means this will be the standard rate per unit. This will be the standard rate per hour, which is the rate that employees get to be paid per hour. And this will be standard hours, as I mentioned, that 8 hours, it is standard hours per unit. Remember the standard hours per unit, which is the 8 hours, just to bring your attention once again to this. The standard labor hours, which is 8 hours, is the one that we'll be using when we do our direct labor variance, where we said that our direct labor variance, we have to calculate the we have to calculate the standard hours. And to calculate the standard labor hours, we need the actual production, and this will have to be multiplied by the standard labor hours per unit. So now this is the standard labor hours per unit, which is the 8 hours that I was referring to. So the 8 hours is the standard labor hours per unit. Then after we go to the next part in the question, and the next part in the question is, or in the standard information, is the variable overhead variance per unit. Therefore, now that will be 8 hours at 30 cents per hour, meaning the 8 hours once again is the standard labor hours per unit, and that at 30 cents, although they're supposed to have given or written an R there to show that this is in rands, that will be 30 cents per hour, which is the predetermined overhead rate, which is based on the direct labor hours. Therefore, now that will be the overhead rate per hour. This will be the variable overhead rate per hour. Therefore, now we'll also apply that when we are doing the variance, as I did emphasize that. Then now we proceed to the next one, and the next one is the fixed overhead variance, which is the fixed overhead cost, or the fixed manufacturing overhead, which is 40,000 rands per month. So now this is the budgeted fixed overhead, because the information below says the budgeted figures. So now this is the budgeted. Then if we get to know the actual, then we can be able to calculate our budgeted fixed overhead variance. Then now we are given production, and this is 10,000. Remember, the 10,000 is also budgeted production. And this budgeted production, remember, it was from there because they said the following information is budgeted. So now that means also these are the budgeted units that we have to take into account. Remember, there was a variance that required us to know the budgeted production. And that variance was under the fixed overhead, where we had to calculate budgeted hours, where we had to calculate our budgeted hours. Here we had to calculate budgeted hours. And budgeted labor hours, it was budgeted production, which is the 10,000 that we have just seen. 10,000 times by the standard labor hours per unit, or the standard rate per unit. The standard labor hours per unit, and the standard hours of labor per unit, we know that is 8 hours, meaning the number of hours it takes to complete 1 unit of a product. Then if we multiply the two, that will give us 80,000 budgeted labor hours. It will give us 80,000 budgeted labor hours. So now that will be how we get to the budgeted labor hours, using the budgeted production and multiplying that by the standard labor hours per unit. So now we proceed in that same note. Remember, all this information was a budgeted information. So now from here, we are no longer dealing with the budgeted information, but we are now under the next part of the information. Then it says fixed overhead are allocated to products using direct labor hours as the basis. So now, as I did show you that in the variance, fixed overhead and variable overhead, we use a base, which is direct labor hours, to allocate our overheads. So now we are given in the next part, where they say to us that the actual operation results, or the actual operation results for April were as follows. So now that means this is actual information. This is what actually took place, which will tell us that if there is a variance or there is no variance. Then now we we are given the direct material purchased and issued to production. Remember, material, when it gets to be issued to production, that means we start utilizing or using that material for the purpose it was meant to, which is to be converted into becoming a product. So now this is material purchased. Therefore, now again it is material used, because if we issue material to production, that means we bought it, and if we issue to production, it means we are using that material, as I have highlighted that. Meaning the 89,000 kgs of material is the material purchased, and at the same time it is the material used, because it was issued to production. So now material purchased and the material used is the same amount in this scenario. Remember, it will not always be the case in the exam. And the actual cost that we incurred to buy this material was 27 cents per kg. So now I prefer to put rands there so that you are able to differentiate that we are dealing with the rent amount now. So now these kgs were bought at 27 rand per kg. Remember, there was a standard price of material, and that standard price of material was 25 cents. That means we budgeted that per kg we expect to buy our material at 25 cents. However, when we went to the supplier, we found that the price is no longer as what we have budgeted. So now the actual price is no longer the same as the standard price. Therefore, now obviously we can say that there is a variance which is unfavorable, because we actually pay more than what we expected to pay in the beginning. Then now we proceed on that same note. We are then given the total labor cost, and our total labor cost is 96,480. Then after, they give us the actual labor cost per hour. That means employees now, although we previously budgeted that we will pay our employees 1 rand 40 per hour, but in actual fact we ended up paying them 1 rand 44 cents per hour in order for them to complete the product that they are required to produce. So now that means obviously in this case we will definitely have an unfavorable variance. Now we have to calculate, based on the information provided to us, the number of labor hours, because if we know the total labor cost and we also know the rate at which employees are paid, then we can be able to calculate the actual labor hours. Let us calculate the actual labor hours. Actual labor hours. And our actual labor hours will be the total cost of labor, and the total cost of labor is 96,480, and we divide this by the rate per hour, and the rate is 1 rand 44 cents. And if we do that, we will get to the actual labor hour. That means the number of hours it took to manufacture the actual products that were manufactured, which is the 8,000 units to be forward. Then we have 96,480, and we divide this by 1 rand 44 cents. Therefore, now this will give us 67,000 hours. 67,000 hours. 67,000 hours of labor. That means it took 67,000 hours of labor in order to manufacture 8,000 units, which is the completed units. So now these are the actual units that were produced. So now let us proceed with that same note. So now, and remember, the reason why we do these calculations is because if we know the rate per hour and we also know the total hours, we can just say the rate per hour times by 1.44. This will give us the total cost of labor, because employees are paid, or were paid actually 144 per hour, and it took 67,000 hours for them to complete the 8,000 units. Therefore, now that will mean now the total cost of labor is exactly what it is given to be in this scenario. So now, please also remember that this exercise also get to be linked with other questions in terms of information that you need to know. Other things, I will not explain them in details, just go through it, because we have already touched base on how you can calculate by reverse the number of labor hours. Then now we are then given manufacturing overheads, and our manufacturing overheads are given to be a total of 18,090. So now the minute we have our manufacturing overhead, remember, we also need to know the actual rate of overhead per unit, because we previously estimated that our overhead per labor hour will be 30 cents. We expected that our overheads, variable overheads, will be 30 cents per hour. So now we need to check the actual one now, if is what was budgeted or is what is on standard the same as the actual. So now in this case we can do such. And how do we do that? We will have to say overhead rate, our overhead, which is variable, let me be specific, variable overhead rate, variable overhead, actual variable overhead, actual, because this is actual information, actual variable overhead, actually variable overhead per hour. We have to take the actual overhead. Here we have variable overhead 18,090. We take 18,090 and we divide this by the actual labor hours. Our actual labor hours is 67,000 hours. Why do we divide by the actual labor hours? Is because in the variance I did specify, and it is made mention clearly to you, that our overhead, our variable overhead, we allocate them using or according to the labor hours. So now, hence, if we have the labor hours, we can use the labor hours to calculate how much is our overhead rate per unit. So now that's why we divide that by 67,000 labor hours. Therefore, now when we do that, we'll have to say 18,090 rand, divide that by 67,000. And after we divide that by 67, it will give us 0.27 cents, which is per labor hour. Per labor hour, which is the actual hour. The actual rate is 27 cents per labor hour, which is the actual rate that was incurred in terms of variable overhead. And this is also some information that you must be able to calculate if you are given a scenario of this nature in any type of question. Then we have our actual fixed overhead, and we know that our budgeted fixed overhead were previously given to us as 40,000. There we had our fixed budgeted overhead, 40,000 rands. Remember, the information that is provided on the table is budgeted, the budgeted figures. So now all this is budgeted. And here they say, so let me just say number 1 and number 2. Information number 1 up to here is budgeted, and this one is the actual operation. So now we are comparing, remember, budgeted and the actual, so that if there's a difference between the two, then we'll calculate what is called a variance, which is the difference between budgeted and actual information. So now we had 40,000 of the budgeted, then now we have actual fixed overhead being 37,000. So now obviously one can say that there's a difference of 3,000, which is a variance, which is budgeted fixed overhead variance. But we'll also do that later on. But I just want to make sure that I do the comparison so that you get to see the picture of this whole scenario of the topic called standard costing. Then now we are given or told that completed units is 8,000. This is actual production in other terms. This is actual production. This is actual production. Actual production. So now whenever we do variance like standard labor hours and the standard quantity, remember we need the actual production. We need the actual production. When it comes to the standard quantity of material, we said that we need to know the actual production. Just to show you this once again, we said that standard quantity is equal to actual production times by the number of labor hours it takes to complete 1 unit, which is, the number of material kgs it takes to complete 1 unit, which in this case it was given to us. We do have the standard kgs, and that standard kgs or the standard material was provided in the exercise. I think it was given. Let us just confirm to that. it was 10 kgs. That was the 10 kgs. That will be the standard material kgs per unit. So now that is the completed units. As I mentioned to you that the 8,000 is the completed units. Then now from here we have to do the variance as it is required. Let us do the variance as it is required in the required information. So now we are then, they continue by telling us that Selina Close Corporation uses the FIFO method to value its inventory. First in, first out is the one that is being used. Then now they say calculate the following variances, which is material price variance and material quantity variance. Price and the quantity variance. And now this variance, please also be aware, I will do a cross-reference all the time so that you are familiar with this. Our material price is the standard price minus the actual price times by the actual quantity purchased. Then now the material usage variance is standard quantity minus actual quantity times by, or actual quantity used, take note, times that by the standard price. So now let us do the variance as they are required in this exercise. So now first variance that we are doing, let me just confirm the numbering. First variance that we are doing is the material variance and this is numbered. This is numbered as A, B, C, D up to I. So now these are the variants that we'll be doing. So now we are doing material variance, which is material price variance. And our material price variance, we know that it is the standard price minus the actual price times by the actual quantity purchased. Sorry, actual, yes, times that by the actual quantity that were purchased. Let us just go and confirm that if is it really actual quantities that were purchased. Now then the formula will tell us if we are correct or we are not correct. And surely the formula does agree with us that is actual quantity purchased that we multiply with. Therefore now we times that by the actual quantity purchased, and we know that, please also do emphasize that it is the one that is purchased. Then our standard price of material, it was 25 cents. Let us check if is it really 25 cents. Our material was given to us as 25 cents, which is on the budgeted information. 25 cents, which is on the budgeted information. And honestly, our standard, it was 25 cents. There we did have our 25 cents. So now that will be the 25 cents I am referring to. So now we have to say 0.25. We minus the actual quantity, the actual price, sorry. And our actual price, and I think it was more than what we expected, or more than what we budgeted. So now let us go and we look at our actual price in terms of material. How much did we actually pay to our supplier to buy the material, which is obviously different than the one that we have estimated. So now let us go to the price, and the actual price is given to us in terms of material as 27 cents. So now that will be our 27 cents per kg. So now we can see that our information or our actual is different from the standard. Then we say subtracting 0.27 and we multiply this by 89,000 kgs. We multiply this by 89,000 kgs. And our 89,000 kgs was the actual production or actual kgs that were bought, which was under actual information, where they said direct material purchased and issued to production. So now that means we purchased 89,000 kgs. So now this is what is purchased. As I did mention to you that all that was purchased was all issued or utilized into production. Therefore now that will give us the variance which will be 0.25 minus 0.27, and we times that by 89,000 kgs of material that were purchased, 0.25 times by 0.27. Oh, sorry, 0.25 minus 0.27. Then we times that 0.25 minus 0.27, and we times that by 89,000, and it gives us 1,780, and this is unfavorable variance. This is unfavorable variance, and I also want to specify that it is unfavorable, which is 1,780, which is unfavorable. Then after we go to the second variance, which is variance number B. And variance number B is the material usage variance. This is the material usage variance. And our material usage variance is calculated by saying standard quantity minus actual quantity used. And we times this by the standard rate or the standard price. We times that by the standard price. The standard price, sorry for that, I say standard rate, which is standard price. Otherwise, I use the right figure. Standard price minus actual price. Then we take our standard quantity. Remember, standard quantity must be calculated first. However, actual quantities that were used, we know that it was 89,000 kgs. But we need to calculate our standard quantity. And we know that standard quantity is actual production times by standard material kgs per unit. So now we take our actual production, and our actual production is 8,000 units that were completed, actual production. Times actual production, we have to multiply that by the standard kgs per unit. That will give us the standard quantities of material, which will be 8,000 times that by 10, and I did do that, and it gave us 80,000 kgs, which is the standard kgs of material. That is how we calculate our standard kgs, which is 80,000 kgs. Then we times that by the standard price, and our standard price, we know that it is 25 cents, 0.25 cents, which is the same 25 cents that we used previously. That was our standard price of material per kg. Therefore, now that will be 80,000, and we have to say 80,000 minus 89,000. 80,000 minus 89,000. Then we times that by 0.25, and this will give us 2,250. And 2,250 is also negative. That means this variance is unfavorable. This variance is unfavorable. So now that will also be another unfavorable variance. Then we go to the next variance, which will be the labor variance. And the third variance will be the direct labor variance, which will be the direct labor rate variance. This will be the direct labor rate variance. Please do write that as a variance. Then now we know that direct labor is the standard rate minus the actual rate times by actual hours. It is the standard rate minus the actual rate times that by the actual hours. I will not do cross-referencing all the time, guys, please. We have our standard rate of labor and our standard rate of labor per hour. Remember that we are using the rate per hour. Our standard rate of labor per hour, it is R1.40 per hour. Employees are getting paid or are budgeted to get paid R1.40 per hour. Therefore, now this will be R1.40 minus actual rate, and the actual rate will be the actual rate that employees got paid in the production of the 8,000 units. And we know that the actual labor cost per hour, which is R1.44, will tell us that there is surely a variance in this case. This will be R1.44. Then we times this by the actual hours, And if you still remember, actual hours, we calculated that to be 67,000 hours. And we did that by saying total direct labor cost, which our total direct labor cost is that one. That total direct labor cost, remember, it was provided to us. Total direct labor cost was 96,480. And we divided this by the rate, if you still remember, and then the rate, actual rate was 1 rand 44 cents. And from there, we're able to determine or to calculate what we call the actual labor hours. So now that is where the actual labor hours are coming from. Therefore, now let us once again determine the variance in this instant. Then we have to say 1 rand 40 cents minus 1 rand 44 cents, and that will give us 4 cents. Then after we multiply this by 67,000 labor hours, and this will give us 2,680. This will give us 2,680. And the 2,680 will tell us that surely this variance is unfavorable, and it's negative 2,680, and it is unfavorable. This variance is unfavorable. So now we proceed on that same note. We proceed on that same note. Then now we do the labor variance, which is the direct labor, which is the direct labor efficiency variance. Direct labor efficiency variance. Remember, the efficiency variance will be looking only at the hours. Then after, it will be standard hours minus actual hours, standard hours minus actual hours, times that by the standard rate of labor. And you know that the standard labor rate per hour is 1 rand 40 cents. That is the standard rate. Then now our standard hours, remember, standard hours must be calculated. And I'm not sure if we did calculate our standard hours, but we know that to calculate standard hours, we need to know actual production, and we multiply that by the standard labor hours per unit. I just want to take it from the initial variance. Our standard hours, it is actual production, which is, we know that actual production is 8,000. Times that by the standard hours per unit. And standard hours per unit is the number of hours it takes to complete 1 unit of the product. Therefore, now we have to times this by 8. And when we do that, we say 8,000 completed or actual production. Times this by 8, and this will give us 64,000 hours. This will give us 64,000 hours as the standard hours. So now that will be 64,000 hours. 64,000 hours minus actual labor hours, and our actual labor hours, it is, let us check our actual labor hours if we did calculate them or not. Yes, we did calculate it to 67,000 hours. Therefore, now we times this by the standard rate. Remember, the actual hours is the same as that actual hours. Then our standard rate, we know that it is 1 rand 40 cents. A standard rate is based on the budgeted information. Our standard rate is based on the budgeted information, and our budgeted information is provided to us, and we do have that budgeted information, and our standard rate there, it is 1 rand 40 cents per labor hour. Don't forget, it's not per unit, per labor hour. Then now we have to determine a variance once again here, where we say 64,000 minus 67,000. Then we multiply this by 1 rand 40 cents, and this will give us 4,200 as a variance that is unfavorable once again. So now this will be 4,200. This is so unfair because you can see that the company does not know how, they cannot stick to their budget, because all the time, as we have seen, that in terms of the material and in terms of the direct labor, the variance are becoming negative, indicating that the company cannot control its cost along the way, or cannot control its process. So now we once again have unfavorable variance. And therefore now we are done with the labor variance. Then we go to the overhead variance. We go to the overhead variance, and in the overhead variance, which is variance number E, we have variable overhead variance, variable overhead price variance, variable overhead price variance, and that variance says standard rate minus actual rate times by actual hours. Our standard rate, we have to go and look for that, but we know that actual hours, they don't change. They remain 67,000. Standard rate will be based on the standard information, or it will be based on the budgeted information. That's where the standard rate will come from. And remember, the standard rate must be per hour, per labor hour. There is the standard rate, 30 cents. The standard rate is 30 cents. And I say that, no, that is in rands. 30 cents. Our standard rate was 30 cents. Therefore, now we say our standard rate is 30 cents, 0.30 minus our actual rate. And I think we did calculate our actual rate if it was not provided to us. Our actual rate, there we did have our actual variable overhead per hour, and that actual was 27 cents. There we do have 27 cents, our actual rate, which we have to calculate that because we were not given, but there was necessary information to calculate that. Therefore, now that means the actual was less than as budgeted. Therefore, now we have 27 cents. We times this by the actual labor hours, of which our actual labor hours is 67,000 hours. Then now this will lead to a favorable variance once in a while. 0.30 minus 0.27, and we times this by 67,000, and this will give us 2010. This will give us 2010. And this 2010 is fortunately or finally a favorable variance, 2010. Then now this will be favorable. This will be favorable variance. Then after, under number F, we then do the fixed or the variable overhead, the variable overhead efficiency variance. I just want to change the color so that I have different flavors. We have variable overhead efficiency variance. Then now this will be standard hours minus actual hours times this by standard rate. Standard hours, they don't change. The same standard hours you calculated in the labor. Standard hours is 64,000 hours minus actual hours does not change, the same 67,000 hours, but the rate now, which is the standard rate, is 30 cents. Standard rate will be the overhead rate, the variable overhead rate, which is 30 cents. Therefore, now we say standard hours 64,000 minus actual hours 67,000 times this by 30 cents. This will give us 900 as unfavorable variance. 900 as unfavorable variance. 900 as unfavorable, or they sometimes call it adverse variance. At 30th level, they will speak of that language called adverse variance. Then after now, we go to the fixed overhead variance. We go to the fixed overhead, which is G, fixed overhead variance. Then now under our fixed overhead expenditure, we start with that one, fixed overhead expenditure variance. Fixed overhead expenditure variance. Fixed overhead expenditure variance. fixed overhead expenditure, and I said to you that they sometimes call this fixed overhead spending variance, expenditure variance, and we know that this variance is budgeted minus the actual. It is budgeted minus the actual, which is budgeted information minus the actual. This will be budgeted fixed overhead, budgeted fixed overhead minus actual fixed overhead. This is one of the simplest variance, minus actual fixed overhead. Actual fixed overhead. And we know that our budgeted, I think it was 40,000. Our actual, it was 37,000. I'll just do a cross reference. And that I previously calculated, and it led to a favorable variance of 3,000. It led to a favorable variance of 3,000. I'm not sure if I said previously it was favorable or unfavorable. Now we go straight to that variance. Remember, it is this variance that we are doing. Budgeted fixed overhead, which is budgeted, this is the one, budgeted fixed cost minus actual fixed cost. So now let us check if how this variance look like. And this variance is given to us. We had our budget 40,000, we over budgeted, and our actual was 37,000. Our actual was 37,000, and there was a variance that was favorable, which was 3,000 rands. So now that is once again a favorable variance. Favorable variance. Then now we go to the next variance, and the next variance is still within our fixed overhead variance, and that will be the last variance before we do the sub 2 variance. That will be the last before we do the 2 sub variance, and that variance is standard hours of labor minus the budgeted hours of labor, and that variance they call it fixed overhead volume variance. GH fixed overhead volume variance. Volume variance. Fixed overhead volume variance is standard hours minus budgeted hours. Then we times this by the standard rate. Remember, the standard rate will be the standard rate of the fixed overhead per labor hour. Then our standard hours, we know that it is 64,000 hours. Standard hours, the same standard hours as it was calculated when we did the direct labor. That was 64,000. The same 64,000, which was actual production of 8,000, times that by the standard labor hours, which was 8 hours, therefore, which was 8 hours, then that gave us the standard hours of 64,000 hours. Therefore, now we proceed with that, but now we have to calculate our budgeted hours. Remember, budgeted hours are based on the budgeted information, meaning now we have to say our budgeted hours is equal to budgeted production. Remember, budgeted production times that by the standard hours per unit. Times that by the standard hours per unit. Standard hours per unit. And we know that our budgeted production was 10,000 hours, times that by 8, and I did calculate this. It gave us 80,000 hours. So now let us check if where is the budgeted production. Budgeted production will be 10,000 units, which is from the budgeted information. There we do have production budgeted 10,000, times this by budgeted or standard labor hours per unit, and our labor hours, standard labor hours per unit is 8 hours. So now that is what we did. 10,000 times by 8, and that gave us 80,000 hours as budgeted. So now I think this is the last major calculation. Then this will give us 80,000. Then we times this by the budgeted fixed overhead rate per labor hour or per hour. Fixed overhead rate per hour. Then now we have to calculate that by the fixed overhead, which in this case it was not provided to us. So now we were only given the budgeted overhead or the budgeted fixed overhead, and our budgeted fixed overhead was 40,000. Therefore now for us to calculate the budgeted rate, we have to say our standard rate, fixed overhead standard rate will be budgeted fixed cost of 40,000 divided by the budgeted hours, and the budgeted hours is 80,000. Divide that by the budgeted hours, which is 80,000 hours of labor. Then this will give us the budgeted overhead rate of 50 cents. The reason why we divide by 80,000 budgeted hours, it is because our fixed overhead are based on labor hours or are based on direct labor hours. So now the minute we know that this is budgeted fixed cost, we need to know the budgeted base, and our budgeted base is labor hours. Then we divide that by the budgeted labor hours of 80,000, and that will give us the budgeted rate, which is the standard rate in terms of fixed overhead, which in this case was not provided to us. So now we just said the 40,000 and we divided that by 80,000, which is the budgeted labor hours, and that gave us the 50 cents in this case. So now we have to multiply this by the 50 cents, which also the calculation is very crucial because you might not be given this. Remember, in this case, what are we doing here? We are simply calculating what is called, we are simply calculating the POR. And we know that POR is budgeted fixed overhead. And our budgeted fixed overhead in this case is 40,000. So now we say budgeted fixed overhead. This is budgeted fixed overhead. Divide this by budgeted base. And our budgeted fixed overhead is how much? Our budgeted fixed overhead is 40,000. Divide by the budgeted base, which our base is 80,000 budgeted labor hours. Therefore now, hence we get to the 50 cents. I want to put more emphasis here because this is very, very crucial. Now, if you, let us say you had used the budgeted cost of 40,000, because if you wanted, you could have done that 40,000 divided by 10,000 units, which is the budgeted units, because we're already given our budgeted units. So now if you do that, you get to the budgeted units of 10,000. And say 40 divided by 10. Remember, the amount that you will get here will be 40,000 rands divided by budgeted units. Remember, this will give you 4 rand per unit. This will give you 4 rand per unit. And remember, we are not looking for the per unit one, but we are looking for the per hour. Therefore, now this will be per unit. Then now we are looking for the POR per hour, not per unit. Therefore now you first have to say divide again by the number of labor hours it takes to complete 1 unit. And we know that it requires 8 hours to complete 1 unit. Therefore now we have to divide by 8 hours per unit. Then after you divide by 8 hours per unit, this will give you the same 50 cents. And this is very important, please. And it will be tested obviously at also in your 3rd year level on how to convert the fixed overhead cost per unit into becoming the fixed overhead cost per labor hour. Therefore now we will have to say, in this case, 64,000, divide this by, minus 80,000, and we multiply this by 50 cents, and this gives us 8,000 as our variance. Then we get to 8,000 as our variance. Then now this 8,000 will be an unfavorable variance. As you can see, we have 8,000 as an unfavorable variance. unfavorable variance. So now from here we have to do the subvariance as they required us. We have to do the subvariance as they required us to do so. So now we have to do the two subvariants. And please, the fact that I don't go to the requirements is not because of anything, it's because I already know which variance goes after which variance. I've done all of them. I've done the material, both labor rate and labor efficiency, variable expenditure and efficiency. I've done the fixed and I've done this. So now this is where I am in the I variance. When they say now we must split the fixed overhead volume variance into two subvariants. So now I said when they require you to do this in simple terms, they are saying you must do the last two variants in the formula sheet for us. These are the two variants they are referring to. Hence I said here 2.1 and 2.2 because these are the subvariants of the fixed overhead volume variance. So now we proceed with that note. Then now we will have to do these two variants, which is fixed overhead volume variance and fixed overhead volume capacity variance. Fixed overhead efficiency variance is the one that we are doing, which all of them are under I. Fixed overhead volume efficiency variance and capacity variance. Fixed overhead volume fixed volume efficiency, then we know that it is calculated by saying standard hours minus actual hours times that by standard rate. It says standard hours minus actual hours times this by standard rate. And standard hours has not changed, still the same 64,000. Actual hours, the same 67,000 hours. Nothing has changed. Then we multiply this by the standard rate. The standard rate is the one that we just calculated. Here was the standard rate. Standard rate, we calculated that to be 50 cents. That is where all the figures are coming from. Then now we get to our variance, which will have to be unfavorable, I suppose. 64,000 minus 67,000. And we times this by 0.50, which is 50 cents. And this gives us negative 1,500 unfavorable. Then we go to the last variance, which is the fixed overhead volume capacity variance. Fixed overhead volume capacity variance. Then this will be fixed overhead volume capacity variance. Volume capacity variance. Then now we are doing this, and we know that it is calculated by saying standard or actual hours minus budgeted hours. We know that actual hours was 67,000 hours. We know that actual hours was 67,000 hours, and we also know that standard hours, actual hours minus budgeted hours. Actual hours was 67, and budgeted hours we calculated that. Let me check that. We have standard hours or actual hours minus budgeted hours is actual hours minus budgeted hours, and our actual hours minus budgeted hours times this by the standard rate, and our actual hours, it is 67,000 hours, and our budgeted hours, we did calculate that previously. Our budgeted hours, there it was actual budgeted hours, which was 80,000 hours. Remember that budget, it was based on the budgeted information. where we said 10,000 units times by 8 hours, and that gave us 80,000. This was standard hours, and this was budgeted units. We multiply those two, and that gave us 80,000. That's where the 80,000 came from. Please just refresh on that. Then after we multiply that by the standard rate, and our standard rate of fixed overhead is 50 cents. And this is supposed to give us a variance of 6.5, so that the net of the two becomes 8,000. Then we say 67,000 minus 80,000. That is 13,000 times by 50 cents. And this gives us, as usual, negative variance of 6,500. Negative variance of 6,500, which is unfavorable. So now if you say this plus this, it should give us negative 8,000. And this negative 8,000 is the 8,000 that we calculated in the first variance, which is that 8,000. So now that's why they say these two variants are the subheadings of the previous one. Always make sure that the sum of this 1.5 and 6.5 gives you 8,000, which is the fixed overhead volume variance. Now, with that being said, guys, I have covered all that with regard to this video. Thank you for that.